Welcome to this morning's live housing market update. Wanted to start by saying happy Friday. I hope we can all finish this week strong. And for the first time, you guys, in my entire career of YouTube, I have done a full week of morning lives. And I'm not talking about a 5-day week, you guys. This is my 7th day straight of doing a morning lives. So let me know that you guys still want me to do this. Everything is going to be chaptered. I really appreciate you guys joining me. You know, the morning lives allow me the opportunity to really keep our hands on the pulse like every single day, and then also inject a little bit more consumer value. So we don't just have to talk about headline news. We could talk about what we should be doing as consumers and how to win and how to find a great deal. So I'm really excited. I really wanted to say thank you. Again, you guys, finish this morning, finish this week, finish this day strong, and enjoy your weekend. Now, obviously the theme of the video is inventory, right? So I just wanted to let you guys know, that, with all my heart, okay, with all of my heart, with all of my soul, I think the inventory shortage is an absolute lie. I know for sure we have enough houses. The problem is right now, guys, is those houses are not up for sale. But when we look at the sheer amount of houses that we have that are not up for sale, I mean, do we really have an inventory shortage? We have 15 million vacant homes. Obviously, we have shadow inventory like crazy. I'm going to throw that up on the board here. And what I'm going to do next week, guys, is I'm going to drive my butt around Houston. The weather's a little bit cooler. And I'm going to show you guys, and I'm going to find all of the inventory that is not listed at MLS, because I really want everyone to understand just how much inventory is off market, right? But is still for sale. So I'm going to go to those new home building communities. I'm going to bring up the MLS, and I'm going to show you guys again, and I'm going to find multiple homes that are not even listed. So again, I don't see an inventory shortage, you guys. In that way, I see, a lack of homes for sale. But also, let's not forget the golden handcuff effect. Those people, existing homes, right? We're talking about existing now, not new homes. The people that are golden handcuffed, when the rates go down, they will sell their property. So when that happens, there will be a flood of additional existing inventory. Now, the question is how long will that last before that buying demand comes and picks that up? Nevertheless, guys, we also have inventory coming from STRs, or short-term rentals, not necessarily because of the vacancy rate or recession, but specifically because the laws are banning short-term rentals. And honestly, a lot of those people still haven't even started selling their properties. So if they do get caught up, in a whirlwind, there is for selling an STR or Airbnbs, I mean, they really have no one to blame but themselves, because these laws have been in place, especially in New York, for over a year. So we're going to start seeing a lot more of that, guys. And then don't forget this, okay? As far as Wall Street's concerned, as of right now, there's a lot of net selling going on in Wall Street, which means a lot of these companies that are used to purchasing single family residences and converting them to rentals, they're now selling more than they're buying. And that's really good for us as consumers, because that's going to lead to more inventory and less demand. Now, also, guys, don't forget this. Each year we have 1 to 2 million forced sales in real estate. So really, the thing is as long as the demand keeps getting wrecked right now, and as long as the demand keeps getting exhausted, we're fine. And you want to know what's really frustrating to me, guys, is, the chairman or the chair at the National Association of Realtors is, keeps going out there saying that we need 4 to 5 million homes, that we're short 4 to 5 million homes. But the reality is, guys, is we only need 600,000 units. If we have 600,000 units of active listings, everything is going to change. Okay. It is what it is. Now, what I wanted to talk about. Oh, also, guys, I made you guys an outro. Okay. I didn't do the intro today because some people hate my intro. I did an outro. I hope you guys like it. So stick around. Also, guys, one of the things we're going to do some consumer value today. We're going to fill out this form. So we will do a market analysis today. Hopefully I'll give you guys that don't know how market analysis works that value. And if you guys can, give me a subdivision. Give me a subdivision in Houston, because I'll do a market analysis on whatever subdivision you guys want me to. So please comment below and give me a subdivision, but it has to be in Houston, okay? Now let's talk real quick, guys, about school loans. Now, when school loans start, and I'll get you guys more details on the penalties and the grace periods, but essentially, guys, when school loan starts, it's almost as if interest rates, like residential mortgage rates, go up another 1.5%. So if interest rates right now are 7%, when student loan payments start, you can equate that to 8.5%. And the reason I'm saying that is the payment is on average, it depends on the metrics that you guys look at, is $350 to $400 per month. So let me show you guys exactly what I mean right here. All right, so here's what I wanted to show you. Basically, guys, this is the average loan amount, $338,000. Here's an interest rate of 7%. Here's the payment of $2,249. Now, remember, when school loans start, the payment's going to be $350 to $400. So again, for the people that have those loans start, let me show you guys. Again, it's like their interest rate goes up 1.5%. So you see how I changed the interest rate and I increased the interest rate 1.5%, and the difference in payment is roughly $350. So, my heart goes, I don't have school loans personally, but that's the effect. Essentially, that's what that means for purchasing power. So their purchasing power takes another hit of 10 to 15%. And I'll look and give you guys more details again on the grace period. Now, let's think again and talk about the prices of houses. Now, there's only a couple things that are going to happen, okay? Everyone makes 60% more income, or the prices go down. It's really simple to understand that, right? In order to sustain, we have to make a lot more money. And I'll welcome 60% increase in income myself. I would love a 60% increase in income. But the reality is, guys, is incomes are not going up. They're going down for most people. Let me show you, okay? And then we'll get started again. Here's an article. This was released this morning, you guys. So this is from this morning. Household incomes rose in just 5 states last year. That's it. We have 50 states. We have 50 states in the U.S. The other 45 states went down with wages, went down with income. The opposite is happening. I mean, honestly, guys, if you're out buying right now, buy at your own risk. If you get caught up in this thing, you really can't blame anyone but yourself. Obviously, we can blame the Fed, but you guys know what I mean. Geez, look at how much indicators we have of caution. Now, I do have some good news, you guys. Let's take a look at the 10-year. We'll start our market update right now. I'm going to do my first timestamp, you guys. I'm trying to get through this. I'm sorry, it's taking me a little bit. Let me show you where we're at in the 10-year, you guys. Huge movements in the 10-year. I believe this is another record. We're at record territory with the 10-year. I know we were at 4.33. I think we're at a record. I will go back, you guys, but this sucker right here is skyrocketing. Just got some new inflation reports out. This bad boy right here is a beast. And this is really what's crippling so many people right now, as far as corporate world and banks and things like that. You guys, 4.333 is what we want. And let me show you the 5-day, okay? So basically we ended the week, well, today's not over, but we started the week at about 4.28 to 4.29. So more than likely, we're going to end this week up. And honestly, guys, that is a very, very, very good thing, because we need demand to stop. Literally, if we could just, as Americans, get with one another and say, all right, we're all on timeout, we're all going to stop buying, then the people that are going to pay the price is corporate world. It's going to be the builders, but right now, the fact that people are still buying, they're the ones that are going to pay the price. And the price is some people will be able to pay the price. Other people will not be able to pay the price. And it is what it is, guys. And I hope you guys don't fall into that. But if you do, and if you did buy, just buckle down. All right. Buckle down, stay focused, and don't forget to love people. I'm telling you, do not forget who we are. So many people forget who we are, especially when it comes to politics. But I'm going to tell you who we are. We're people that love our real estate mindset community. We help each other. And that's the premise here. I'm going to say that all the time. And I'm going to bring up some comments here in a second. And I'm going to tell you guys how proud I am of you. I see you guys helping people in need. And that's what we want to do. When we help people in need, we also help ourselves. Here's the interest rates, guys. We're sitting at 7.24%, quarter 7%. That's also a very beautiful thing. You guys can see just the skyrocket here. Going back to 2014, this is beautiful. We want them to be elevated. We will go into the weekend probably close to 7.3, right around there. Let me bring up the amortization schedule. You guys know how much I love the amortization schedule, because this is an opportunity in the video for empowerment and awareness to really kind of hit you in the brains. And I see you, Johnny. I'm trying to focus. I see Johnny down there trying to troll me. I love Johnny. You guys don't have no idea. And by the way, give Johnny a little bit of encouragement. He's going to do his first video on Saturday. You guys, anyone that's part of the real estate mindset community, if you guys have businesses, if you guys have adventures, whatever it is, email me and I would love to talk about it on my channel. I would love to grow together with you guys. So whatever projects you guys got, including my man Johnny, I want you guys to email me and we grow together. No matter what, we grow together. As long as we're on this path, we're all growing together. Here's the amortization schedule. This is the average loan amount of $328,000 on a 30-year, and this is today's interest rate. So on today's interest rate, 7.24%. If you guys want to buy right now, that's fine, but just understand over 30 years, you would be paying $476,000 in rush fees or lazy fees, or I mean interest fees, not rush fees or fear of missing out fees. We can call this, instead of interest, fear of missing out fee. So the fear of missing out fee is right here. It's $476,000. By all means, if you need to buy, go ahead. And honestly, guys, the real interest rate here is closer to 130 to 140%. Okay? The real interest is not 7.24. It's 130 to 140%. When we rent, it's only 100%, but we don't have the asset, obviously. But let me show you guys, okay? Now, in this scenario, I've been trying to talk to you guys about putting money down on your amortization schedule. And in order to do that, you have to close first. Okay, this is not a down payment. People got confused when I was talking about this with the down payment. A down payment is separate. So this amortization schedule happens after you close. Okay, so we've closed the transaction. We now have this amortization schedule, and an amortization schedule is how mortgage works. And mortgages, you guys, are front loaded with ridiculous amounts of interest. In fact, if you guys want to retire, lend mortgages to people. You make so much money doing mortgages. It's crazy, you guys. But look at this. I wanted to point out, now in this situation, remember our starting balance is $328,000. Now you don't even need $20,000 like I've been preaching to you guys about. If you guys just put $18,500, not even $20,000, y'all. It's still a lot of money. $18,500 is a lot of money to me. If it's not a lot of money to you, hit me up. It's a lot of money to me. Send me some money, y'all. There's inflation. I got 5 kids. I'm just kidding. I have 4 kids, but sometimes I count myself as a kid. Anyways, guys, I'm so sorry. So if you put $18,500 down after you close straight to your principal, you guys save 5 years, okay? But you also save $115,000 over the course of the loan. And the reason that is, guys, is take a look here, okay? Take a look at the first year of payments. So the first year of payments, again, what I'm trying to explain to you is this is front loaded with interest. Here's year one, okay? Year one, paying this payment up here, $2,200. You're going to be paying $23,000 in interest. But look at when I scroll down here. Okay. When I scroll down here, year 30, you only pay $1,022 in interest. Y'all see that? Year 29, you only pay $2,800 in interest. So they gouge you hard. Do y'all see what I'm saying? They gouge you hard for the start of the loan. But once you get towards the end of the loan, almost all of your payment goes towards your principal. This is how you guys save a ton of money and get yourself out of the rat race, right? Get yourself out of the rat race, okay? Don't be a victim like all of these people. And also, having said that, understand how dangerous refinancing can be. You don't just want to refinance because you start the interest game all over again. Remember how damaging the amortization schedule can be, okay? I'll be happy with just that alone. Just the awareness. Now, how much can we afford now? Okay, if you make $100,000, we're going to take today's interest rate. And here's a good thing, guys. These charts that I'm bringing up for you are linked in every single one of my videos. I am one of the rare people that believes in free education. Okay, and I do plan on making a home buyer's course, and I'm going to put my heart and soul into that course, and I'm going to offer it to y'all for free because I want you to know that I'm in this with you. I will not charge you for that course. Again, like I said, we all grow together. And again, I'm working on that course. It's going to be free 99 for all of you because I want you to do well. Okay. So give me some time on that though. I'm putting my heart and soul into that. But anyways, guys, we're going to see $100,000 income. All right. $100,000 income, 30-year fixed rate, 30-year mortgage, today's interest rate. Now here's the average monthly debt. This includes credit cards. This includes the auto loans. This includes student loans, on average, $1,400 a month. That's brutal. Down payment average is 18%. Very interesting. Property tax, we're going to average 1.5, even though in Texas it's a lot more. HOA, $400 a year. Insurance, 0.5. And what I did, guys, again, you guys can come back here. But if you guys want to really kind of calculate where you're at, what I do is I select the 45% down here. Oh, you can't see that because my name. But anyways, guys, there's a 45% option right here for DTI. Just go ahead and select that. Now, if you want true numbers, you get with a loan officer. Okay. A loan officer's job is to go through all that numbers. I was a loan officer 22 years. I know how to do this, but you're going to want to select 45% to get the most realistic calculation. All right. And so I select 45%. Now, when I calculate this, if you make $100,000, the average home that you guys qualify for is only $304,000. You guys, I still remember when I was a kid and $100,000 was like, you made that if you're rich. So again, if you make $100,000 and you have $54,000 down, isn't that a lot of money? Am I the only one that thinks $54,000 is a lot of money? I'm not. I mean, how many ultra rich people are watching us? I mean, $54,000 is a lot of money, guys. I mean, geez, that's a lot of money. Now I got that much money in my T-bill, so I'm making money back. You know what I mean? Like, we should be putting our money in like T-bills right now, and it's so easy to do, by the way. But look at guys, the average person. I'm sorry, the above average person making $100,000 doesn't even qualify for the median sales price or the average home price. Not even close. But let me show you how damaging these $1,400 monthly payments are. This is why I constantly say, and this is where I like Dave Ramsey. Okay, Dave Ramsey is spot on here, and I for sure he is. Monthly debt payments destroy your purchasing power. That's why I started with the school loans. Once those school loans start up, it's going to hurt because it takes away from your qualifying power, right? Now, I wanted to show you if this person had no consumer debt, okay, and I recalculate this with no consumer debt, they're going to go from $300,000 to $489,000. Do y'all hear me on this one? Now, obviously, their down payment goes up substantially to 88 grand. Okay, so their down payment's going up substantially. But y'all, I want you to think about what I just told you. Again, the person, if you're making $100,000 on average, you only qualify for $300,000. But if you want to escape the rat race, if you want to be above average, and I'm not talking about income, I'm talking about how you live your life, you can qualify for another, roughly in this example, $189,000. Is that not big, you guys? I mean, seriously, is that not huge? That's huge, right? Is that not huge? That's huge. That's huge. All right, guys, we're going to go into our first video. And again, comment below while this is playing. If you live in Houston and you want me to do a market analysis on a subdivision, we will be doing this market analysis today, okay? But I do prefer that you guys give me a subdivision. One of the last times I did that, y'all, someone actually put an offer on a house when we did a market analysis. So I'm not saying put an offer on a house. I want to show you how this works. So again, you guys go ahead and put a subdivision while this is playing. Our first video is from our girl, Danielle DiMartino. So she put another video up. I'm only going to play about 6 minutes of this. This is an hour-long video. I suggest you guys look at it. She's offering very good perspective, in my opinion. Everything will be linked, but let me go ahead and throw this up right now. And again, throw up those subdivisions, like I said, if you can, and let me know that the audio is okay. We're going to listen to our first video. And we will listen to that right now. I just had to add that to the stage. You guys let me know that the audio is okay, all right? Uh-oh, I don't think that the audio is okay. All right, hold on one second. Okay, the audio was okay. But unfortunately, what happened, y'all, is we're going to listen to
right now. So
no inventory, okay? I got to play commercial. So she's going to go into a lot of the things like shadow inventory, and shadow inventory is huge because shadow inventory is inventory that is off market, that's not being counted. So that's what we're going to listen to, y'all. I'm going to just turn this up. I got it working, and please enjoy and let me know that the audio is okay. I'm still getting used to lives. You guys know I'm a new YouTuber. I still barely even know what to do, but I hope you guys enjoy. Again, please let me know the audio is okay.
So, and by the way, I do follow Melody on Twitter. I haven't interviewed her on this channel, so I'm just taking that a note to send her an invitation. I'll let her know that you were the one who made the plug. So like funny, Danielle, we hadn't before this sentence, talked about housing. Right? I mean, talk about people that are praying for a return to ZIRP, right?
I mean, the sheer number of individuals who are being highlighted, and I feel badly for these people on social media who are saying, I absolutely have got to get out from under the yoke of this investment property. But the purchases were made based on weekly cash flow assumptions, not monthly. But what am I going to be able to generate even if I'm across the country buying a property that's thousands of miles away, what does Airbnb suggest that I'm going to be able to generate off of this property so that I can create this nice flow of cash, nice flow of income for myself? Well, these were not mortgages that were designed to be put on hold for 12 months. While domestic travel, whether you're listening to Alaska or Southwest Airlines or JetBlue, while domestic travel clearly takes it on the chin, and the employee retention credit sent people off to Gay Paris, and they were all doing all this international travel. But if what looks to be occurring is occurring, and what's the impact on domestic travel and on Airbnb, there's more shadow inventory out there than you can shake a stick at. And in addition to that, we've got all these apartments coming online, and we have all of these home builders building spec homes as quickly as they can. So I understand that it's really awesome to talk about, the number of properties that are not on the market. But, to reference Melody Wright going to this one community where 55 plus aged people literally went into a near riot because their homeowners association fees were rising because insurance premiums were going so much in the state of Florida. Well, as things turned out, she looked into this one little community where on the community's website, there were 100 listings for purchases and rentals. And you look on MLS, you look on realtor.com, 16. So I think that 18 months from now, 12 months from now, we're going to be talking about the shadow inventory that was, not some boogeyman that keeping Danielle up at night, but that was a real thing building into if it's not saved by zero interest rate policy and the resumption of QE, where are we going to be in terms of, oh my gosh, there's too many homes out there?
Yeah. Gosh, I mean, we could make this entire discussion just about what's going on in the real estate market. So let me try to just wrap it up in the sense of little good. Right. I mean, at least until mortgage rates come
I'm
back.
Interrupting you for a second, Adam.
Yeah.
You're like, I'm James Joyce, and then you have to riddle in Danielle. Anyways, continue.
Okay. Not at all. You're knocking out of the park with the analogies today, Danielle. Let's put it that way. But nothing good, at least until mortgage rates like really come down substantially. There doesn't seem to be a lot of reasons to have a ton of hope for that anytime soon. And we didn't really even talk about commercial real estate, which is an even worse situation. I mean, it's bad. It's really bad now, right? I live out in the San Francisco Bay Area. We've got really big property owners in San Francisco that are jingle mailing, hotels and massive office buildings, right, back to the banks. So it's already started in earnest here. So, okay, so we have all of this coming drag effect from the lags that we've been talking about that's going to hit the economy. Presumably, we haven't mentioned this specifically, but I'll give you a chance to opine on it. That is going to lead to an earnings recession, right, in corporate America. That is then going to trigger layoffs. That is obviously going to be really bad for the housing market, right, because you're going to have a lot of people lose the incomes that they're currently using to pay today's housing prices. So therefore, that should make a housing price correction really kick on in earnest. If I heard you correctly, you don't see this as like a tree falling. In other words, it's a short, sharp event. You see this as like a slow grind, just rolling thunder happening over quarters, probably years. Correct me if that's wrong. So I'm kind of taking it, if I wrap everything up in a bow from you, as kind of like, this is a gird your loins moment where, we really need to be thinking ahead and saying, okay, if I work for a living, if I work for a paycheck, how should I be thinking about what's going to happen to me if my employer struggles, if I get a pink slip, et cetera. If I'm a homeowner and I have a lot of equity in my home, I got to make some decisions pretty quick, right? Do I sell and pocket what I have? Or do I risk maybe writing this thing down over the period you're talking about here? Obviously, from an investment standpoint, and we'll talk about this in just a second, but you got to ask, okay, great, what investments make sense for this type of future? So before we get to that part of the conversation, did I summarize kind of your general outlook correctly there?
Yes, Adam, you did a very, very good job. So
okay.
You are the riddler.
All right.
You guys, great interview. I don't want to play too much of it and take too much of their content, but great interview from people that have a different perspective. And, I like what she is going into as far as like the shadow inventory. It's a real thing. People don't realize that. And remember, guys, I went around the nation to like boots on the ground to find this information out. And I went all over California, all over Texas, but it wasn't until, and I actually Seattle as well, but it wasn't until I hit Phoenix and Las Vegas to where it really hit me in the face. Like, oh my God, why are there thousands and thousands of spec homes, which means they're already built, without owners? And I'm telling you guys right now, and you guys remember me calling you this, there's going to be a huge hotspot. I think it's going to be an epicenter in Phoenix area, but it's specifically in Phoenix, Desert Oasis and Copper Canyon. If you guys are out in Phoenix, literally go drive right now or sometime today or over the weekend and go look at Copper Canyon and Desert Oasis, and your minds will be blown. I went to several subdivisions there, y'all, that almost the entire subdivision was already built, but not one person lived there. Literally hundreds of houses that have been built. Not a single person lives there. Desert Oasis, Copper Canyon, boots on the ground. I went there, and they don't list all of that type of stuff. Now, I'm going to show you guys what I'm going to do, okay? This is what I'm going to do. So part of what I'm going to do next week is, because it's a little bit cooler in Texas, it hit triple digits. So I'm going to be going out to these communities. Okay. This is just an example. I'm going to be going out to these communities, and I'm going to tell you guys whether or not there's legitimate shadow inventory. So for example, like here's a community right here. It says it has 12 homes, but do they only have 12 homes? Right. So I'm going to be going into MLS. I'm going to be going onto their website, and I'm going to tell you guys with proof. Okay. With proof, again, what's really going on. And I think you guys are, I think you guys are going to be happy with what we find out. So that's going to be a big deal. Again, you guys, I really feel like, this whole lack of inventory, it's complete nonsense, especially, I mean, seriously, think about what the head of the National Association of the head. So it trickles down to the agents. Think of what he's saying. He's like, guys, you got to go buy a house right now because we're short 4 million houses. How scary does it sound when someone says, like the head of the National Association of Realtors, when he says we're short 4 million houses? But the reality is have we ever had 4 million? We've never had, that I can see. We have never had 4 million active units. Never. This is crazy. You guys, we sit on average 1.2. On average 1.2. We're at about 800 right now. So we're what? That's actually 400,000 off. We're 400,000 off. When we get that type of inventory, prices can't sustain. Prices are propped up because of that low amount of inventory. So when that inventory comes back, come on, guys, what happens to prices? Think it through. What happens? Okay, especially when more and more people are forced into selling. Now, this all really, really depends on whether or not the Federal Reserve can keep us elevated. Right? They've messed up this year, in my opinion, in March 2023. They messed up. They kicked the can down the road, $400 billion. So as long as that doesn't happen, I think we're going to be perfectly fine. The shocking thing to me is like how few people understand, how few people understand this. It's really, really crazy. I really hope you guys are getting the perspective. We're going to go into our second video. Our second video, you guys, is from the Bulls. And this video is going to basically break down the inflation reports that just came out. In other words, guys, even though a lot of things are crumbling in the housing market, in the market overall, there's still parts of the market that have inflation. So in other words, what I'm trying to say is the Fed's not done. So if you guys think that the Fed's going to cut rates this year or anytime soon, understand their inflation fight rages on. And in fact, inflation went up. Take a listen to this video, you guys.
We're waiting the August read for producer prices, the wholesale version, of course. Headline number expected to be up 0.4 is up significantly more, up 0.7, up 0.7%. That's the hottest read going back to June of 22 when it was up 0.9%. And if you strip out, excuse me, I was looking partially at retail sales. Now, if you strip out food and energy, that was retail sales up 0.6%. Ex-autos up 0.6. Ex-autos and gas up 0.2. The control group up 0.1, and that's much stronger than expected. Now, that 0.7 on PPI headline I just referenced, well, if you strip out food and energy, it drops to 0.2, exactly as expected. And if you strip out food, energy, and trade, It's up 0.3, and that's a little bit on the hot side. Last time we were up 0.3 here was February last year. Last time you were up more than that was up 0.5% in January of this year. So we can see that those numbers have moved a little bit. And if we look at final demand year over year, and these are important, up 1.6, up 1.6. It was supposed to be up closer on expectations to up 1.3. And in the rearview mirror, that was up 0.8. That was up 0.8. So up 1.6 is actually the hottest read since April, when we were up 2.2. And if you strip out food and energy year over year, it is up 2.2%, exactly as expected. That's 0.2 shy of the 2.4 in the rearview mirror. And if you look at PPI X food, energy, and trade year over year, up 3%. That's a bit hotter than expected by 0.3, both on expectations and the rearview mirror. The last time we had a number in this category was April of this year, when it was up 3.3. Now, let's move to initial jobless claims. And by the way, you notice the two punch we had? We dropped significantly on yields. Now we've turned it back around. So it was a bit hotter PPI, and also some of the influences earlier of the ECB 10th consecutive rate increase. Jobless claims 220,000. That's 5,000 less than expectations. That's 4,000 more than the rearview mirror. But we could still see a revision. 216,000 on our last look was actually the lightest number, going back all the way to December of last year. So now let's look at continuing claims, always a week in arrears. So there could be some influence there with the holiday issues. 1.688 million. So 1,688,000. That's almost spot on with expectations, and just a smidge higher than our last look. I continue to point out that we've gone from 422 and 10s back up very near 427. A high yield trade moments ago around 428 and 10s. So we want to pay particularly close attention to two things. We've talked before that when we extended this rally in yields or sell-off on the face value, it took out some of the October high yields in the long maturities. Those yields in 10s happen to have been 4.25. And I said at that time, it was technically significant. We're going to have yields more biased to the upside and very sticky around 4.25. And we see that continues to be true. Becky.
Yeah, and he's right, guys. The 10-year has been sticky at 4.25. Let me check that again, see where we're at with that. Okay, we're still at about 4.3. So, what I got from that video, y'all, is, it's pretty clear to see that there is still inflation, and the inflation, it's clear to see where the inflation's at. The housing market. I understand gas has gone up. Like, yeah, that's bad. Gas has gone up. Yeah, but like the housing market's a huge problem, because the housing market, you can't just snap your fingers and prices go down 30%. It's a long haul. So it's really important that we see things that are happening right now that are going to calm and cool and balance the housing market out right now. And again, unfortunately, the people that are not waiting and that are not purchasing, with some level of goals and skill, they're the ones that are going to pay the price here. And it's like, to me, it's clear as day. But let me show you what the market's doing, guys. Let's visit the overnight reverse repo facility real quick, so I can show you that, day over day, it's kind of been balanced for the last 2 days. The market's trying to figure out whether or not the Fed is done raising interest rates. So once the market, what will happen is when the market thinks that the Federal Reserve is done raising interest rates, this is going to go down, because there's going to be a flight from the short-term money. This is like printed money. This is like COVID money right here, right? It's like, it's not excess savings, but it's a heck of a lot of money. So when the market thinks the Fed's done, all of this money goes bye-bye. And they're probably going to invest in maybe 2-year treasuries, or who knows, 2-year or 10-year, but this is kind of plateaued. So I'm thinking the market is anticipating that additional rate hike. Let me show you guys the inversions. This is the 10-year and the 3-month. Usually we look at the 10 and the 2. So this is the 10 and the 3. And I wanted to point out this is the longest time in history that we've been inverted as far as the 10 and the 3. Longest time in history, and this is only going back to 1982. So, like, buy at your own risk. Y'all see what I'm saying? Like, we have historical precedent for caution, for warning, to hold the line. Cash is king. So many economic indicators. And the amazing thing, guys, is even though we have these like bad things to come, it's like there's still inflation though. We still have problems. We can see that here in the 5-year break-even inflation. The market is saying, yeah, you're not going to get to your 2-year goal. So if the Fed stays to that 2-year goal, there will be more breaking in the market. There will be layoffs. There will be credit tightening. There will be more companies filing bankruptcy. But the 5-year break-even inflation has trended up. Now, it went down slightly year over year, but the market understands that the inflation fight is brutal, and inflation, after all, is not transitory. It's not transitory at all. And look at what the market's saying about interest rates, you guys. Now, I don't care. Basically, September's off. November is only 34%. December is only 37%. So the market's all over the place. But I wanted to bring your attention here to June, because the market is saying more than likely first of the rate cuts, it's probably going to have, the market is saying, keep in mind, the first of the rate cuts, it's probably going to be right around June. So that's probably when they're going to start the rate cuts. Now, even though they're going to start the rate cuts potentially, you guys, that doesn't mean mortgage rates are going to go down a full percent. They may only make a 1/4 point adjustment. And we know that the federal funds rate doesn't track mortgage rates. So say they do start cutting in June of next year. We may not feel that in mortgage rates for another few months. So tread lightly. In other words, what I'm saying is just because they start cutting rates does not mean things are going to get drastically more affordable right away. There's going to be a process of easing down, right? Easing down. So anyways, guys, we're going to listen to our next video right now. Our next video is going to go on consumer spending. Now, the person you guys are going to listen to, obviously it's CNBC, so they're going to be a little bit bullish, but they're going to go into the health of the consumer. And I want to just point out before we listen to this video, remember that consumers are running out of money. Despite what this says, excess savings is supposed to be depleted completely by the end of this month. School loans start next month. Credit card spending the trajectory is out of control. Defaults are above pre-pandemic for both credit cards and auto loans. Bankruptcies are surging at unprecedented rates. So, all right, let's hear what this guy has to say about the health of the consumer. If you guys can, let me know that the audio is okay.
Is Chief Investment Strategist at Citi Private Bank, and David Tinsley is Senior Economist, Bank of America Institute. It's great to have you both here.
Thank you.
David, let me just start with you because you guys can kind of unpack this a little bit. How much of the spending we've seen in recent months, broadly speaking, is just price increases?
Well, some of it's that in that retail has been boosted by gasoline prices. But in our data, when you look across the piece, you see very strong service sector spending as well. So, and when you look, really broadly at the sort of balance sheet of the consumer, it's in pretty good shape. So I'd say
it's pretty good shape,
but certainly not all.
We've spoke with your colleague Liz, who says, and there's a huge debate about this, is the consumer's kind of like excess savings or dry powder, is it running out and we're about to face this trifecta of student loan repayments and higher gasoline prices and all, higher borrowing rates? Or are we still in a better position than we might have been a few years ago, supported by real wage gains? So what do you guys see happening there?
But what we're seeing is that on the deposit side, they're up about 30-40% across all income cohorts.
Amazing.
So that looks pretty solid. On credit cards, people aren't tapping their cards relative to their limits as much as they were in 2019. The utilization rates are still lower. So, in the round, we think there's dry powder still in the consumer. There are a few headwinds, student loans, as you say, but all manageable, I think, over the next 6 months or so.
Rent.
How does that jibe, Steve, with kind of your view on things and what you think is going on with the consumer?
So look, it doesn't really lend itself to a complete bust or boom view. It looks like a deceleration. 3 years ago, we had an absolute depression in services employment. And services employment rarely falls very much, even in recessions.
Right, very steady.
And so to get all of that back is actually helping a lot. It's actually working through some of the problems we have in the goods sector. We have manufacturing recessions, trade recessions, and we're getting inventories down because of this persistent strength in services hiring. Now, the whole thing is growing half as fast as it did a year ago, and it doesn't just stop there. It'll probably continue to decelerate with some of these headwinds, but it's getting us to a place where we just are not going to have that collapse that happens when you have a full-blown drop in employment of serious magnitude.
More of a cyclical thing. So when you look, jobless claims, okay, last week we thought, well, maybe distorted by, Labor Day holiday, they were very low. This week, again, very low. It doesn't seem like a seasonal issue. It seems like a cyclical tell. And do you think that this kind of this ongoing rebound in services is still why. How much longer does that have to go?
You know, the claims data, again, are really high quality data. There's no samples, everything. You know, we love this data, but it's not showing the entire picture. When you take a look at job openings, have fallen by 2.6 million.
Right.
And again, the net pace of hiring is decelerating. So the net firing, or people being able to quickly find another job, it's still painting a picture of stability overall.
So David, if we kind of go, okay, well then maybe I can understand why a camp like Goldman's goes, okay, recession odds are down to just 15% in the next 12 months. I'm amazed to hear you say that credit card utilization rates aren't at the levels they were in 2019, at the same time as we've seen delinquency levels reapproaching where we were back then, and rates kind of on a nominal basis are so much higher.
Yeah, I mean, behind this, all of this is really the labour market strength. So when you look at the lower income part of the distribution, wage growth has been at the strongest, above that of middle and higher income. So I think, you know, that's driving, in a sense, the ability to borrow and the spending picture. So, you know, there are corners of households, the market, where people are feeling some stress vis-a-vis, you know, borrowing, etc. But it's minor, I think, really, ultimately.
For now. So, Steve, the final question then, as it comes down to the Fed, which is not expected to hike this month. I don't know what your expectation is, if there's, you know, maybe another hike in November when they start cutting. How does this shake out for them?
So they've done a lot, and they're doing more with quantitative tightening.
Yeah.
Just take a look. Again, it not only is the Fed reducing its treasury holdings, but foreign central banks appear to be doing the same thing. And if you apply some lags here and the fact that employment growth is decelerating, you could say, well, 187,000 jobs, that's still too many. Well, where is it headed?
Yeah.
And I think if you look at next year, you're going to say the Federal Reserve is probably going to back off of sort of a really ultra tight monetary policy. It's not going to give us zero rates again. But the whole point is they don't want to. We shouldn't actually need a collapse this few years after a deep recession.
All right.
So, I don't know, guys. You know, the reason I played that for you guys is because I know you're hearing it as well. That's incredibly bullish. Basically, they're saying, yeah, there's 40% more savings in consumers' bank accounts, blah, 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 blah. But the interesting thing is when we go to the personal savings rate, again, this doesn't say how much money is in their account. When we look at reports, people are saying that actually in October, the excess savings will be gone. But I find it very suspicious that they're saying how great the consumer is doing. You know, when one of the, you know, tragedies right now is Americans can't save money, probably a result of how they spend money and also how unaffordable things are. You guys, we are hitting, you know, we're sitting at a really sad, really scary, pathetic savings rate, household savings rate of 3.5%. That's it. To give you guys an idea of what it should be, if we look back to the 70s and 80s, and I say that because they were also going through an inflationary battle, they were able to save, consumers were able to save through recession. So the US entered recession, they were still able to save 9 to 11% through recession. Right now, we're not even in recession, and we're at 3.5%. That shows me that, you know, the consumer's not okay. The consumer's not okay at all. And honestly, guys, if we look at the inflation, I mean, why would people think the consumer's okay? The consumer appears okay right now because they have all of the COVID savings. And then the job market is booming because they had the PPP, the EIDL. I mean, when we really watch the money, it's easy to see. And it's really still shocking to me, though, how the market just does not learn their lessons. When we look at history, when we look at the inflation, when we look at all these things that are designed to keep us within, you know, a market of fundamentals, it's all broken. Everything is broken. Now, here's the inflation, just to give you guys an idea. Here's core, and then here's overall, and you guys, it went up. So they're not done. I'm showing you guys this because, you know, they're doing, I guess, pretty good progress, right? There's core, there's overall, but we just had an uptick. So, you know, there's a strong possibility, y'all, that, you know, we have a second round of it. Basically, if the housing market doesn't crash, because we know we're not getting a 60% income increase, if the market doesn't crash, we're going to have a second round of inflation, and they're going to have to do quantitative tightening again. You guys heard it from me first. If the housing market doesn't, and I'm going to use the word specific here, crash, there's going to be another round of inflation, and there will be another round of rate hikes. That's what I believe anyways, which would be way which would be actually really bad. So let's listen to our last video before we dig into our market analysis. Now, our last video is going to be on investors. It's going to go into a little bit of Airbnb, and it's going to talk to you guys about, the meltdown in commercial financing and the meltdown in commercial real estate, which is a very, very big deal. There are so many headwinds and cross currents right now. But the thing is, guys, is like the moment that the market thinks that everything is safe again, people are going to flood back in. So that's why, again, we may have 6 years to find a great deal. We may have 3 years to find a great deal. But what I'm trying to explain to you guys is don't prepare for that. Prepare for a year to 2 years of finding a great deal. And in order to prepare for that, we really have to keep increasing our purchasing power and really understand what our goals are, right? I hope you guys are feeling me right there. Let's listen to our last video and then we'll go into our market analysis.
The ongoing weakness in the office sector isn't going anywhere. The major headwind will cost banks as much as $250 billion. Let's bring in Yahoo Finance's Danny Romero with more. Danny, what are you watching on this?
Rochelle, what's going on in the commercial real estate sector doesn't look pretty. And the major stress here is the low occupancy rates due to the ongoing work from home phenomenon, the hybrid that we have been seeing, and also the higher interest rates is putting pressure on landlords that have to refinance their loans in the near term. Most of the owners of the commercial real estate sector have been able to take advantage of those near zero interest rates over the past decade. Well, that's not happening anymore. And if we combine the higher rates with the falling property values, that could be one of the 1-2 punches that the commercial real estate sector is dealing with and could lose. Some of the banks could lose over $2.5 billion. That's what one hedge fund manager is saying out there, Kyle Bass. He revealed that banks are really under a lot of pressure right now, especially the office space. And that could represent about 10% of the combined $2 trillion in equity in commercial real estate that the banks are exposed to. Bass says that there's other areas of commercial real estate that actually are doing well, that have somewhat of a leverage right now and are solid. Some of those are the industrial real estate market, multifamily housing, which we definitely need in the US, and the data center spaces. Rochelle?
And staying in commercial real estate, let's also pivot to the high-end mall space. We're seeing the European owner of Westfield now scrapping the plan to sell nearly all of its US properties. Unibail Rodamco Westfield is planning to hold some of their top-performing malls. So, Danny, can you tell us what this means then? At first, everyone thought the mall was dead.
Well, not every sector in commercial real estate is doom and gloom. And this is just a prime example from the European owner of the Westfield malls, really backtracking and pulling back its original plans of really getting rid of its American profile. So last year, the company said that it would sell its American profile, but now the plans have really changed after, kind of seeing what's going on the forefront. But also we have to highlight that they have invested billions of dollars in some of these malls. And if you invest, most likely some of that will be in return. And so that's what we're seeing. One of the prime examples of this is that they expanded in the San Jose, San Francisco area. And so that mall has really been seeing a lot of uptick. But overall, this really does signal that the mall maybe not is dead as of right now, but adding those attractions, investing in these malls is likely obviously pulling some foot traffic in. Rochelle?
So perhaps the mall is on crutches, but at least not dead yet. There's still some movement going on there. Thank you, as always, our very own Danny Romero. Thanks so much.
All right, guys, that's the last of our video. So what we're going to do now is we're going to move on to our consumer awareness section of this video. Let me timestamp that right now. What we're going to do is a quick market analysis. It probably will only take, hopefully, about 10 minutes. So I'm going to try to complete this, guys, in about 10 minutes. And remember, one of the reasons why we want to do a market analysis, because we need to understand the data. We don't want to believe Redfin, Zillow, our agents necessarily. We want to have faith in ourselves and our own ability to find what we're looking for. Now, again, in order to do that, we need data and understand what data I'm talking about. Normally, to understand what a value of a house is, we need something called comps, okay? A comp is just a name for saying that a house has sold. But it's also important to understand where you get comps. comps are usually chained to the property subdivision. So that's why we got to go into the subdivision. Some subdivisions will, have a lot of amenities, and that will lead to a higher price per square foot. And then other subdivisions will have like no amenities, which will lead to a lower price per square foot. So in other words, guys, it is hyper local. So this is what I'll be filling out. Here, let me set this up, okay? So I'm going to be filling out this. You guys, please copy this. This is for y'all. I know my writing is awful. I put my rent on the top. You guys see that right there? So my rent right now is $2,400. Now, the subdivision that we're going to review today, I had a viewer say this, and I prefer to do market analysis for y'all. So the subdivision we're going to look at today is in Houston, and it is called Post Oak Point. Guys, this is only going to take about 10 minutes. This is something that you do yourself if you're a realtor, or do this if you are interested in purchasing, or not necessarily interested in purchasing. I don't want to say like, go buy right now necessarily, but like this is what you need to do to understand your market, right? So you have to understand your market. And that's really what I'm trying to say here. So I'm going to be going into my MLS, guys. And this is what my MLS looks like. And then I'm going to go back to the full picture of our market analysis, but this is what I'll be, actually, hold on one second, you guys. I'm trying to figure out how I want to set this up for you guys. Actually, I'm just going to keep it here. You guys already know what my MLS looks like, which is right here. Okay. So that's what my MLS looks like. I'm just going to go and access this information. You guys already know this part. I'll set this up for you guys so you guys can see the bare minimum, but I really want to point out how I'm filling out the form. But all we do, if you're a realtor, is we just set it up to search. The matrix, honestly, guys, if you're realtors, if you're a realtor, this is everything. Like Redfin can't touch you. Zillow can't touch you. These trolls and these investors can't touch you if you have access to the system. This system, you guys, allows me to figure out who's lying, who's not lying. So what I'm going to be doing, again, we're going to go hyper local. So we're going to put in here Post Oak. And this works, not all properties have subdivisions. So remember that, okay? So not all properties have subdivisions. Like rural property, land usually doesn't. So I'm going to copy that. Now, the first thing I want to do, remember, we want to figure out price analysis. So what I'm going to do to figure out price analysis, I'm specifying subdivision here, and I'm only looking at sold property because sold property are comps for the last year, okay? So what I'm going to do is I'm going to hit my results right here. I have 72 properties. So you guys see that? I have 72 total properties. I'm going to select all properties. Now, if I want to do like an in-depth, I would go through this list and remove outliers, like $1 million properties, right? So you want to be careful that it's not like, those one-off comps. So what I'll do next is I'll just go to stats and hit tabular, and that's it. And I'm good. Like I'm just equipped myself with the average price per square foot in that community, you guys, which is right here. So I'll put average price per square foot on that first line is 100. Whoops, my pen is off, sorry. Is $171.47. Okay, so we have a huge task already done. That piece of information alone, you guys, will give you a ton of stuff. So now what I'm going to do is I'm going to access the rental MLS, because remember, there's multiple listing services for houses for sale, and there's multiple listing services for houses for rent or things for rent. Okay, so again, I'm going to do the same thing on the rental MLS. So you do same thing again, and we want to do this because we want to know what our cash flow is. You guys see I put Post Oak for the last year. We're going to look at rentals. Okay, so let's put this here. We have 27 total in the last year. So here's all of the properties. So 27 properties were rented out in Post Oak over the last year. Now I'm going to select all of the data. So now I have all of the data selected. I'll just hit stats, hit tabular. And you guys, look at this. You guys see how easy this is? This is what you do, okay? So now what do we know? We know that homes rent for, on average, over the last year, $1.28 per square foot, okay? So now what do? We just equipped ourselves. So we go back to, we're going to go look for homes for sale. We're going to get out of the rental MLS. So we're equipped, guys. Do y'all see? We just equipped ourselves. You guys are better than 90% of realtors now in this community. I'm serious. Just those two things alone, you guys could be absolute studs. So now what I want to do is I want to see what's available on the market. All right, so let's put Post Oak Point in. We're going to look at active listings. Let me hit results. And then I'm going to categorize this by price per square foot because I want to see what the cheapest house is per square foot, which is right here. Okay, so the cheapest house per square foot is $155. So let's take a look at this house. Okay, it looks like a nice house, honestly. So what do we know so far? We know we have our sales price, which is $349,000. So I'm going to go back here. And again, what I have done, you guys, is I just went straight to the cheapest house, right? I don't want to look at a million houses. I just want to know what the cheapest house is. So the price for this house is here. Okay, I'll put it $349,990. Okay, now for the size of the house, that's really important, you guys. We need to know the size of the house. I'll put that right here. It's 2,249 square feet. Okay, so we're doing really good. Now let's look at the taxes. Let me get the taxes for you guys. Oh my gosh, oh my gosh, you guys, taxes on this house, real bad. Tax rate is 3.6%. Oh my gosh, you guys, let me calculate that real quick. 3.6%. Oh my gosh. The taxes on that house, you guys, let me see, is $11,700. Dang, they build houses cheap out here, but I'll tell you all, those taxes on the property is really bad. All right, so we've basically put this together. That's really like everything we need, except we do have to calculate our payment, okay? So let's calculate our payment now. All right, so we're gonna go to the payment, and we're gonna put in, let's put in our loan amount. Okay, so the purchase price is $349,990. Let's just say we're going to put 10% down, so we'll have a 90% loan. So that's going to be $314,991. 314, what was it, 991, I think? Okay, so that's where we're at right there. Let's say our interest rate is right now, say 7.25%. But we also want to include taxes and insurance. Oh my gosh, I have to do this again. Okay, so I forgot to hit the taxes and insurance button. We're going to put the loan amount again at $314,991. Guys, understand how I got that? I got this loan amount because I put a 10% down payment. Oh, it already calculated that automatically. Oh my gosh. All right, I'm just going to let it calculate it for me. As a loan officer, you guys, I jump ahead. Drives me crazy having to use these programs because I can figure out a lot of the stuff in my head. But whatever. So we're going to change this to 10% down. Okay, our interest rate is 7.25%. All right, we have to change the property taxes right here. Remember that? Property taxes is a whopping $11,700. It ain't cheap to own, y'all. We'll just keep the insurance as is. Here's the mortgage insurance right here. You guys know I like to pay that off in advance. It's a tax deduction for me, and it lowers my cash flow. Okay, so we've set this up pretty well. We know that our mortgage payment is going to be roughly, again, you guys talk to a loan officer, but we know this is bad, man. Our mortgage payment is going to be so high. $3,370. So I can already tell you by looking at this, because my rent is up here. My rent is $2,400. So what this means is if I want to buy that house, that's the cheapest house in that neighborhood, I would be paying $1,000 more a month, and I would have to come to the table with $40,000 out of my pocket. So I would also lose money on that $40,000 because right now my $40,000 is in T-bills, is in 1 month T-bills. So not only is it going to cost me $1,000 more a month, I'm also going to lose roughly $200 in income a month. So it's actually $1,200 that I'll be losing as far as monthly outflow. Now, I hope you guys get everything. Now I'm going to make this really, really easy. So now we got to figure out what our wedge is, and we got to figure out our cash flow, which is one of the most important things if you're going to buy in 2023, in my opinion. So first, I'm going to calculate these two things, market price and market rent. And all we have to do to calculate those things is multiply the price per square foot by the size of the house. That's all we have to do to get our market info. So again, the first one is $171.47 times the square footage, which is 2,249, which means the market price, there is wedge in this house. So the market price is $385,636. And then what I do is I subtract the purchase price from that amount. Okay, so I subtract the purchase price from that amount, which will give me my wedge. And a wedge is just another name for buying a house under market value, right? So that gives me wedge, you guys, $35,000, $646. Okay, so that's about 10%. So it gives me about 10% a wedge. I'm gonna be honest, guys. If I'm buying right now, I want 20. Minimum I want is 20 for my wedge because look at the headwinds and the unaffordability. But this house actually has 10% of wedge, or rather, it's about 10% under market value. Now, what we have to do is we have to calculate our market rent. And again, we just take the $1.28 up here and we just multiply that, guys. We just multiply that by the size of the house. This is so handy. I'm telling you guys, this allows us to take the emotion out of the home buying process. I hope you guys are doing this. I feel like no one's doing this. Will you guys comment if you're doing this? Can you just put an M, type an M for market analysis if you guys understand this and you guys are doing this. Please just type an M because I want to make sure you guys are getting this. It's really, really super important to me that you guys are getting this, or else why am I here, right? I need a purpose, and my purpose is empowering you guys. So here's the thing, okay? So our market rent, when we multiply 128 by the square footage, is $2,878, all right? But what's our mortgage payment, guys? Our mortgage payment's down here. So the cheapest house in that neighborhood, does it cash flow? It does not. There is no cash flow. The cash flow is negative $492. Okay. So again, if I'm a homeowner on the sideline and I'm interested in Post Oak, I'm renting for $2,400. There's no way I'm buying this house. Like, I like the wedge, but I can find a ton of properties with wedge. What I want is the cash flow as well. I want wedge and I want cash flow. And right now, looking at this is just too dangerous for me. I'm not going to spend another, I'm not going to pay $40,000 as a down payment. I'm not going to increase, my payment $1,000 and be, and if I have to rent it, I'm going to be upside down $500. I'm not going to do it, you guys. So anyways, on this house, I'm passing. And quite frankly, overall, my conclusion with Post Oak Point is it's too high. It's too highly priced. That's my conclusion there, you guys. Based on what I just showed you, it is too highly priced. Now, what I want to do is this last thing. I just want to, and I made you guys an outro, so sit tight for the outro. I hope you guys like my outro. I didn't do an intro because YouTube kills my videos, but I just wanted to bring something up because I'm really proud of you guys. Now, I preach to you guys all the time about how Real Estate Mindset is a community, and what I'm hoping that everyone is working towards is building a community where we help each other, building a community where we understand there are differences of opinions. There are different conclusions, different personalities, different goals, but we can all help each other. And I just wanted to point out, you guys, on the video that I dropped yesterday, I wanted to tell you how proud I am. This man right here, you guys, is reaching out because he's going through divorce. And I went through stuff like that. And I could tell you when there's children involved, especially, it rips your soul out of your body. It's so painful. It's so painful. So this guy was asking for advice. He's going through a divorce. He's talking about kids. And you guys, and this is my last video. I pinned this comment. It has nothing to do with the housing market. I only pinned it because I want you guys to see how much love is in our community. Who cares about the trolls? Who cares about all the hate? Look at the people that matter. The people within our community. You guys go back and read this. I mean, the amount of support from the, and we don't know the situation. We don't know who's right or wrong, but look at the community. I mean, you guys reached out to this man. You showed him love. I could tell you guys right now that meant a lot to him. All right. I just want to tell you guys, if you were one of the people that did that, you helped that man. And I just wanted to say, and I know this is corny, whatever. I don't care. I'm going to be corny. You guys know I'm corny all the time, but I'm so proud of you, and I'm so proud to be a part of it. I don't want bad people. I want to be around good people, and you guys are some great people. So anyways, you guys, I'm going to get out of here. I'm going to play my outro for you guys. Turn up it's only a minute long outro. I wanted to play an outro because it is Friday. I wanted to also say I'm proud of you guys. Let's finish the week strong. Let's be an asset to our company. So finish strong, finish empowered. But you guys, here's the thing. Don't forget who we are.